Options trading is one of those subjects that instantly divides investors into two camps. One side sees it as a dangerous casino, a place where leverage, complexity, and speed combine to destroy accounts faster than discipline can save them. The other side sees it as a powerful, elegant tool capable of generating income, protecting portfolios, and expressing views with precision that simple buying and selling cannot achieve. Both views contain truth, and both are incomplete. Options are neither inherently reckless nor inherently superior. They are amplifiers, and like all amplifiers, they magnify not only returns, but also mistakes, misunderstandings, and emotional weaknesses. At a basic level, an option is a contract that gives the right, but not the obligation to buy or sell an asset at a predetermined price within a specified time. A call option relates to buying. A put option relates to selling. This simple definition hides a deeper reality. Options are not just directional bets on price. They are instruments that embed time volatility and probability into a single decision. When you trade options, you are not only expressing a view on where price might go, but also on how fast it will move, how violently it will fluctuate, and how much time you have for your thesis to be proven right. This is where many beginners stumble. They approach options with a stock mindset, believing that being correct about direction is enough. In options, trading direction alone is rarely sufficient. You can be right about where a stock is headed and still lose money if the move happens too slowly, if volatility collapses, or if the structure of the trade works against you. This disconnect between being right and being profitable is one of the most psychologically damaging aspects of options trading, and it explains why many intelligent investors abandon it after a short, painful experience. The high-risk, high-reward reputation of options comes primarily from leverage and asymmetry. With a relatively small amount of capital, an option can control a large underlying position. This creates the possibility of outsized gains, but it also creates the possibility of rapid total loss of the premium paid. Unlike stocks, which can be held indefinitely, most options expire worthless if conditions are not met in time. Time is not neutral in options trading. It is an active force working for or against you every single day. Another misunderstood element is volatility. Options are priced not only on current conditions, but on expectations of future uncertainty. When volatility is high, options are expensive. When volatility is low, options are cheap. Many traders buy options during moments of excitement, precisely when volatility is elevated, unknowingly. Paying a premium that makes success statistically harder. They confuse movement with opportunity. Understanding volatility is not optional in options trading. It is central. Ignoring it is like sailing without regard for wind or current. Options also introduce a different kind of emotional stress. Because losses can happen quickly, and visibly fear and regret are intensified. Because gains can happen suddenly, overconfidence builds just as fast. This emotional volatility often exceeds price volatility. Without a clear framework, traders oscillate between euphoria and despair, adjusting strategies impulsively and compounding errors. Options do not forgive inconsistency. They punish it with mathematical precision. Despite these dangers, options have legitimate, powerful uses when understood properly. They can be used to hedge downside risk, generate income through structured selling, and define risk more precisely than outright ownership. For example, buying a protective put can cap downside on a stock position. Selling covered calls can convert idle holdings into income-generating assets. These applications are not speculative by nature, but they still require understanding discipline and acceptance of trade-offs. Options always give something up to gain something else. There is no free lunch hidden inside a contract. One of the most important shifts an investor must make when approaching options is redefining success. Success is not about hitting a jackpot trade. It is about executing a strategy with known probabilities, repeatedly managing position size, and surviving long enough for edge to matter. Many losses in options trading are not caused by the instrument itself, but by oversizing positions in pursuit of emotional payoff rather than statistical advantage. When losses are sized too large, learning stops and trauma begins. Options trading also demands brutal honesty about skill level and time commitment. This is not a passive activity for most participants. Markets evolve, volatility, regimes change, and strategies that worked well in one environment can fail quietly in another. Without ongoing education and review, traders fall behind while believing they are still in control. The market does not announce when the rules have shifted. It simply transfers capital from those who did not adapt to those who did. The greatest danger of options trading is not loss, but illusion. The illusion of control, the illusion of speed, the illusion that complexity equals intelligence. These illusions draw people in quickly and push them out just as fast. Options reward humility, preparation, and restraint far more than bravado. They are tools that demand respect, not confidence. As interest in options continues to grow, fueled by easy access and dramatic success stories, the real question is no longer whether options can produce high rewards, but when they serve a rational purpose in a portfolio, and when they simply magnify behavioral flaws, because understanding where options add precision and where they add unnecessary risk is the difference between using them as instruments of control or allowing them to become instruments of self-destruction. And that is exactly where we need to go next, by examining when options trading serves a disciplined purpose and when it quietly becomes a vehicle for self-sabotage, because the boundary between the two is defined by intent, structure, and restraint rather than intelligence. Options add value when they are used to define risk in advance, shape outcomes deliberately, and complement an existing portfolio rather than replace it. A protective put limits downside with mathematical clarity. A covered call converts time into income while accepting a capped upside. These strategies do not promise excitement. They promise control. They trade unlimited potential for bounded outcomes, and that trade is rational when the goal is survival and consistency rather than spectacle. Options begin to destroy capital when they are used to compensate for impatience. Buying short-dated options in search of rapid gains is not strategy. It is emotional leverage. Time decay accelerates precisely when confidence is highest, and small misjudgments compound quickly. Many traders mistake frequency for skill, believing that constant action improves results. In options, trading excessive activity usually signals a lack of edge. The market charges tuition for every unnecessary trade in options. Make that tuition visible and painful. Position sizing is where most failures occur. Even a sound option strategy becomes lethal when oversized. Because options feel cheap, traders allocate too much capital relative to account size. A string of small losses then turns into a psychological crisis, leading to revenge trading and further errors. Professionals survive because they assume losses are normal and size accordingly. Amateurs assume losses are temporary and size as if certainty exists. Options punish that assumption relentlessly. Another dividing line is volatility awareness. Successful options traders understand whether they are buyers or sellers of volatility, and why. They know that buying options when volatility is elevated requires exceptional timing and conviction, while selling options in calm markets demands strong risk controls. Ignoring volatility is equivalent to ignoring price. When volatility contracts or expands unexpectedly, strategies that were profitable can fail without warning. This is not unfair. It is the nature of the instrument. Time horizon discipline also separates use from misuse. Options are wasting assets. Holding them without a clear exit plan invites hope to replace logic. Traders who define exits at entry, both for profit and loss, remove negotiation from moments of stress. Those who do not inevitably renegotiate when pressure rises. Options expose this weakness faster than any other instrument. The most overlooked truth is that options are not necessary for most investors. A well-constructed portfolio of stocks, bonds, and real assets already contains sufficient complexity and opportunity. Options are a specialization, not a requirement. They should be introduced only when they solve a specific problem, hedging concentrated risk, enhancing income from existing holdings, or expressing a view with defined loss. Using options to do more usually results in doing worse. In the end, options trading is not about bravery or cleverness. It is about respect for probability and acceptance of limitation. Used wisely, options can reduce uncertainty and shape outcomes with precision. Used recklessly, they compress years of lessons into weeks of loss. The instrument does not care which path is chosen. It simply executes the math. If this perspective helped you see options trading more clearly, consider subscribing to stay with these long-form conversations that emphasize discipline over drama, and leave a comment sharing whether you view options as a tool for control or temptation, because awareness of that distinction is often what determines the outcome.